Your brother-in-law owns two rentals and won't stop talking about them. Every Thanksgiving, it's the same sermon. Stocks are just paper. I like something I can touch. Meanwhile, your college roommate sold every rental she had and rolled the money into an index fund, and she swears it was the best financial move of her life. One of them is right. One of them is wrong, but not for the reasons they think. And if you've been trying to decide where your retirement income should actually come from, the answer, the real measurable, after the headlines truth about which one pays you more, is buried in a metric that almost nobody brings to these debates. I'm going to show you that metric today. And by the time you see it, you'll never hear the word return the same way again. I'm Matt. I'm not a real estate guru with a course to sell or a stock market evangelist with a brokerage link in my bio. I've lived on both sides of this fence.
I share every single thing I have learned about retirement here. So hit subscribe right now if you want to avoid the mistakes I made and emulate my wins.
I've collected rent checks and I've logged into brokerage accounts. I've had the 2 a.m. call about a burst pipe. And I've watched a portfolio drop 14% in a quarter while my stomach folded in half. What I've learned, through error, not theory, is that the entire real estate versus stocks conversation has been framed wrong for decades. And when you reframe it, the payout question resolves itself in a way that's less about which asset class you pick and more about which problem you think you're solving.
I need to tell you about the winter I owned a duplex that wasn't supposed to be a nightmare. I bought it 12 years ago when I still had a job and a steady paycheck to absorb mistakes. It was a 2-unit property in a decent neighborhood, numbers looked fine on a spreadsheet, and everyone I knew who'd built wealth seemed to own something with a door and a tenant. The first 2 years were quiet. The third year, the winter I genuinely stopped sleeping, the furnace in the vacant unit went out on a Friday night. The temperature was 12 degrees. The plumber, when he finally arrived on Saturday, discovered that the pipes had already frozen and split behind the walls. What followed was a 6-week, $11,400 cascade of drywall repair, plumbing replacement, and lost rent while the unit sat empty. My spreadsheet had assumed a 9% annual return. That year, after repairs, vacancy, and the property manager's fee, my actual cash-on-cash return was negative 4%. Negative! I paid money to keep an asset that was supposed to be paying me. Same year, my index fund, which took exactly 0 phone calls from plumbers, delivered something very close to the market average. I didn't know it then, but I was living inside the exact data point that separates real estate's theoretical return from its actual after-friction payout. And once I started measuring that friction honestly, the entire debate realigned.
So let's build a framework that actually serves a retiree, not a 26-year-old hustler, not a leveraged speculator, someone who needs reliable income and doesn't have a salary to patch the gaps. There are 3 lenses most people use to compare real estate and stocks, and all 3 are incomplete. The first is average annual return. The second is emotional comfort. The third is tax treatment. The argument usually stops there, with each side picking the lens that favors them. But there's a 4th lens that in retirement overrides all of them. It's called recovery time after a negative income shock. And once you see what that lens reveals, you'll understand why some people should absolutely own real estate in retirement and others should run from it. The first incomplete lens, average return. You'll hear that stocks have returned roughly 10% annually over the long run, while real estate, depending heavily on leverage, geography, and management, can deliver comparable or slightly higher returns on invested equity. The problem is that the word average in this context hides a specific kind of violence. An index fund delivers its return in a shape that includes deep, unpredictable dips and long, drawn-out recoveries. rental property delivers its return in a shape that's mostly flat, punctuated by sudden, expensive shocks. Neither shape is inherently better, but a retiree withdrawing money every month lives inside the shape, not the average, and the shape dictates whether your plan survives.
The second incomplete lens, emotional comfort. Real estate advocates love this one. I like seeing the asset. I like the monthly rent check. It feels more controlled. Stock advocates counter. I like clicking a button and being liquid. I never have to evict anyone. Both are right about their feelings, but feelings are not cash flow. The retiree who sleeps well with rental properties often has a very specific setup that makes that sleep possible. Low or no mortgage, a cash reserve for repairs, and a property manager who handles midnight calls. If you don't have all three of those, real estate isn't passive income. It's an unbonded part-time job that can call in sick. The third incomplete lens, tax treatment. Real estate wins headlines here, and for good reason. Depreciation can shelter rental income. A 1031 exchange can defer gains. Stocks, by contrast, generate dividends that are often taxed as ordinary income and capital gains that, while preferential, don't have the same shielding. But, and this is where the retirement context changes everything, most of the tax advantages of real estate are front-loaded during your accumulation years when depreciation offsets your W-2 income. In retirement, when your marginal tax rate may already be low, the tax shield is less potent. Meanwhile, qualified dividends and long-term capital gains inside the 0% bracket can be entirely tax-free, as we've covered elsewhere. So the tax advantage flips depending on your income. For a high earner still working, real estate's a tax gift. For a retired couple with a modest reportable income, stocks inside the right brackets can be almost invisible to the IRS.
But here's the fourth lens, the one that made me sell the duplex. When you're retired, you don't have new earned income to absorb expenses. Every dollar that goes toward a repair, a vacancy, a property tax increase, or an eviction is a dollar that comes out of your monthly withdrawal. In a stock portfolio, a market drop also hurts, but you can adjust by spending less that year or by pulling from cash reserves while the market recovers. With real estate, the negative shock is often non-optional. The broken furnace doesn't care about your spending plan. The tenant who stops paying won't wait for the market to recover before they make your mortgage payment late. And that forced cash need, when it lands in the same year as a broader downturn, creates a compounding effect that most rental property return projections completely ignore. I tracked my duplex performance over the full 7 years I owned it, including the year everything broke. My average annual return on paper was around 8%. But when I calculated the number of months where the property required a cash infusion rather than providing income, and compared that to the sequence of withdrawals I'd been making from my stock portfolio in those same months, a counterintuitive pattern emerged. The stock portfolio had volatility in value, but never demanded sudden large cash outlays. The rental had stable value on paper, but produced irregular, lumpy cash needs that occasionally forced me to sell other assets at inopportune times just to cover the property's own emergencies. The property didn't fail me because its return was too low. It failed me because its return delivery schedule didn't match my life's withdrawal schedule. And in retirement, the matching of cash flows to cash needs is worth more than an extra percentage point of theoretical return.
So, which pays you more? The honest answer, and I'm going to give you the real answer, not a cop-out, is that it depends not on the asset, but on the structure you place around it. But if I had to give a single guideline that fits the kind of retiree I've become and the kind I write for, real estate pays more when you can hold it without debt, with a dedicated repair reserve of at least 18 months of expenses and a willingness to treat its income as irregular. Stocks pay more when you need predictability of spending, complete liquidity, and an income stream you can throttle up or down without a plumber's opinion. What I can tell you from the wreckage of my own assumption is that the person who buys a rental for income without modeling what a bad year does to their withdrawal sequence is taking a risk most retirement calculators can't see.
And the person who dismisses real estate entirely because stocks are easier may be leaving a genuinely useful income stream on the table if they have the cash reserves and the temperament to manage the friction. So here's what I'd ask you to drop in the comments. Not a debate about which asset wins, because I think we just settled that the answer lives in your specific setup. Instead, tell me this. What's one thing about money in retirement that you only understood after you stopped working? Something the accumulation years never taught you.
Now, I want to leave you with a thought that took me embarrassingly long to learn. For years, I convinced myself I couldn't retire because I hadn't found the perfect investment, the perfect allocation, the perfect income vehicle. Real estate versus stocks was just the surface argument. Underneath was a deeper hesitation, a terror that I wasn't ready, that there was some invisible checkpoint I hadn't cleared. What I eventually realized is that ready isn't a feeling, and it's not a net worth. It's 7 specific, answerable questions. I wrote them down. I answered them honestly. And the day I could say yes to all 7, I knew I could walk away. Not tentatively, but for real. I made a video walking through those exact 7 questions. Not the fluffy ones you find in retirement magazines. The ones that actually separate the people who retire with confidence from the people who keep moving the finish line. The first question alone exposes an assumption almost everyone carries into their 60s. Watch it next. It might be the shortest path between you and a date on the calendar.